Well, hello, everybody, again. This is Tim Gregory. I'm with Charlie Fricker. This is the latest in a series of videos, short videos that we're doing, trying to capture some of the themes that have been dominating what has been an absolutely extraordinary market this year. Markets have rallied quite strongly in the last few weeks. And obviously there are some hopes of some form of stabilization in the situation with the Ukraine and Russia, but obviously, we're keeping a very close eye on that terrible situation, hoping that it resolves itself for obviously every reason that you can imagine. But obviously at the same time as that, there has been a other event that has been going on, which is more normal for markets, with the US Federal Reserve talking, hiking interest rates, trying to normalise policy. You were around last week for all of that, Charlie. What did you make of all that?
Well, yeah, it was a very busy week last week. I was with not just Cheltenham, but there we go. So we had the FOMC meeting on Wednesday last week, where I think the market assumed Fed came out more hawkish than expected, and we've seen the reaction to market subsequently. The market is now. So the Fed raised rates, as everyone expected. They raised rates by 25 basis points. And the market is now, post the Fed meeting, pricing in a greater than 50% chance that they raise 50 basis points at the next meeting and possibly subsequent meetings as well. And what the Fed came out with in their new summary of economic projections, new dot plot, is they see rates getting to about kind of 2.4 is their neutral rate. And kind of following on from there, they expect to kind of move into their what they call restrictive policy in 2023, with rates above that level, about 2.8% by the end of 2023 is what they're forecasting, and about 1.8 at the end of this year. And so we've seen markets react accordingly to that. And then subsequently, post the meeting, we've seen Fed Chair Jay Powell kind of almost step up that level of hawkish rhetoric with his comments at speaking events, as have other FOMC members. Now they're kind of free to talk post the meeting. And Powell has openly stated that a 50 basis point hike is a possibility, and they will do it if they think it is necessary, kind of priming the market for that potentially to come through at their next meeting, which is in May. And so we had at the same meeting Bullard, who's the Fed president of the St. Louis Federal Reserve Bank. He came out in a far more hawkish rhetoric than the rest of the Fed. He dissented. First time there's been a dissenter on the FOMC for quite a long time. He wanted a 50 basis point hike, and he's talked about the need to act faster and more aggressively than they are doing at the moment to try and get the reins back on inflation, which they forecast to be 4.3% at the end of the year, which I think if it gets to that level, I think people might be pretty happy with that, given where we're likely to end up going over the next kind of couple of months. And he wants rates to be at 3% by the end of this year to get the economy back into restrictive territory to rein in inflation. And markets reacted to all that. We've seen a big sell-off in the Treasury market. I think yields have backed up well over 40 basis points. We've seen the curve flatten. We've seen inversion across the kind of the belly of the curve, from kind of 5s through to 10s. But equities have managed to rally really strongly on the back of that. The market's performed really, really well since the meeting. And we've been trying to get on top of all of this. And Tim, I don't know if you want to summarise your thoughts on where we are post all of that, which has happened in less than a week. So,
well, I was at Cheltenham last week, as you know. So thanks for doing all that hard work for us, Charlie. But I mean, it is an astonishing situation. We've been saying for a long time that we strongly felt the Federal Reserve was behind the curve and that they should have been raising rates much earlier than last year. And what I have difficulty with is that I feel as though, yes, there is an absolute need for the Federal Reserve to normalise policy as much as they can. But they have to be very careful here, because you have very high levels of inflation, which are really hitting the consumer hard in their pocket, high gas prices, high food prices. All these things are a real challenge to, the consumer. So I really question just how far the Fed will be able to go, and just how aggressive they are prepared to be, and how much they are prepared to risk a recession in the US economy at this juncture. And you mentioned the belly of the curve, and the fact that the 5-year yield is above the 10-year. We're getting close to a point of inversion, which usually is very highly correlated with a recession. And this is a really difficult moment, but at the same time, stocks have performed extraordinarily well, and it does feel like we're in another of those moments where investors are saying, well, there really is no alternative. I don't want to own bonds because bond yields are just going up, because rates are going higher. We've seen a really big spike higher for the whole curve, haven't we? The whole curve has moved up.
Yeah.
And it seems like you would have thought, if we chatted about this some months ago, well, if 10-year gets to 235, 240, growth stocks will be back in real trouble again. And yet, in the last week, 10 days, when stocks have had this very strong relief rally, it actually has been growth stocks that have done better. The NASDAQ has been leading the way. High growth stocks are at high valuations, and stocks that we like, like ASML, like Nvidia, like Veronis, they have led the market higher, not banks. And obviously, banks probably looking for the yield curve to steepen. You would have thought some of those trades would have been better. Obviously, more value-oriented things like oils and materials have been dancing to their own drumbeat because of other factors. And of course, those factors are inflationary. So it is an extraordinarily difficult situation. And one of the themes in our portfolio for many months, many years, in fact, because of COVID, we looked to find stocks that we thought would be COVID winners. And, we had a company report this week, didn't we, Rosa? Nike, which is the first share we actually bought post-COVID and did really well for a while. And we've been trying to wrestle with the idea of the structural long-term growth in athletic wear and the risk to the short term, not just from supply chain related issues, but also from crimping of consumer spending because of higher rates at the same time as higher inflation. And the question whether high rates will make any difference to inflation whatsoever, because these have been driven by external exogenous factors. So how do you think about that? And what did you make of the Nike numbers, Charlie?
Yeah, I think it's interesting that the Fed seems to believe that they can raise rates this aggressively, tame inflation, unemployment's going to remain low, and economic growth is going to remain consistent. You think if they manage to hit all those goals, kudos.
It could be the reverse.
It could be totally different, and we'll just have to wait and see. Because as you said, the inflation narrative, especially stuff that's going to come down the pipe in the next few months, is totally out of their control because of what's going on in Europe, as we know. But in terms of Nike, as you said, it was one of the first stocks we bought coming out of COVID, as we thought the athleisure trend had almost had accelerated, and the business proposition was actually strengthening over the course of 2020. And the stock performed very, very well. And then it's come up against these supply chain related issues, which have caused inventory to be in all the wrong places at the wrong time. But the numbers that Nike came out with yesterday, the stock's pulled back into the results as concerns of a slowdown and where the supply chain situation was worried investors. But I think the results they put up were very, very reassuring. Solid, I call them solid across the board, on the revenue and earnings line. All divisions and geographies performed well. China hopefully is now starting to normalize or kind of bottom out, having had this difficult period on some geopolitical tension between the US and China, where Western brands struggled as a result. But the one thing that definitely came out of the numbers is that management are incredibly confident about where their brand is at the moment, and that demand in the market for their products continues to massively outstrip supply. And because of that, combined with where the inventory situation is and the lack of product in the stores, they're still able to get very, very strong pricing through their business model, which is the reason that we love the shares over the longer term, as they transition much more toward their direct, Nike Direct, as they call it, through their own retail network and through their own online channels, where they generate much greater returns than the wholesale model, where they're really dialing back from and choosing their partners there really specifically. So we think the business is well set up. Next quarter, again, is going to be a bit difficult as the inventory situation starts to normalize. But the company said that all their plants in Vietnam are now up and running. And I think the one thing we've seen in the last few weeks around the whole supply chain dynamics is we've seen China is still sticking with their zero COVID policy. We've seen outbreaks in the Shenzhen region, which has caused these kind of short, sharp lockdowns. But I think now based on what the Chinese seem to be doing, it seems to be a bit more nuanced around this zero COVID policy. You know, the factories in the Shenzhen region were only closed for a few days before they then started to reopen them to get back on top of things. So how that's all going to affect the supply chain dynamics moving forward with outbound exports from Asia, something we're watching closely. But also you've got all of the ramifications that are coming out of the war in Ukraine and what that's going to do for various commodities, what that's going to do to the supply chain dynamics, specifically in semiconductor spaces, with a lot of the neon used in the semiconductor manufacturing process comes out of the Ukraine, and how these are all going to kick on down the line and what the subsequent kind of second derivative effects are going to be. So that's something that's watching, but it's going to be just watch and wait. I think it's going to be very hard to guess where this is all going.
Yeah, well, it's obviously, it is very difficult, but, I think what we would say about Nike is, albeit that there are these short-term challenges, we don't know what consumer spending impact is going to be felt from higher rates and higher inflation, but we do structurally feel that Nike's got a brilliant position in a structural growth industry, the world's leading #1 brand, structural growth industry, a really significant dynamic from growth in women's athletic wear, which we've always identified as a really strong niche opportunity for the business that is going to be a much, much bigger than, analysts have probably alluded to in the past. So, I really see that as a company that's a winner. It's come back a long way. Nike's never a cheap share, and it's not, completely immune to downgrades. And we've seen supply chain upheavals, inventory related upheavals. But under the surface of all that, it does feel like it's still one of the consumer businesses that will be more resilient to all the factors that we see ahead of us, in what are very challenging times. Okay, well, look, let's leave it there. Thanks to anybody who joined in. I hope that was useful. Just as a reminder, Charlie and I are co-managers of the Vermeer Global Equity Fund. We've been going for around 5 years. We've got quite a good track record in that area. Nike is one of the stocks that we own in our portfolio and have been adding to of late. And, we continue to run the portfolio with a clear bias towards the long term and feel strongly that, that is the right approach in what is very, very challenging environment. Thanks very much for your time.